Hey traders, welcome back. In this video, we're going to look at one of the most powerful concepts I use in my trading, which is ranges. I can't tell you how many times I've seen traders get caught chasing fake moves just because they didn't realize the market was simply in a range. This is one of those things that looks simple, but if you understand it right, it can literally flip your whole approach. Let's dive in. So what is a range? A range is when a market doesn't make a higher high or a lower low. Price just moves sideways, trapped inside a box. No strong trend, no direction, just noise on the surface. But that's where the real game begins. This is where institutions quietly accumulate their orders. They build up liquidity on both the buy side and the sell side, getting ready to make their move when the time's right. Understanding this alone can help you avoid so many fake outs. Now let's see how to identify a range and how to use it to build your bias the smart way. So, how do you identify a range? Let me give you a very simple way. We all know about the inside bar candle. That's when a candle prints completely inside the previous candle. Guess what? That's the range right there. It shows you that price is consolidating, volume is drying up, and liquidity is building, both above and below that candle. Now here's where it gets interesting. When a market takes out one side of that range, there's a high probability it will come back and take the other side too. But this only works if you're aligned with the context. You can't trade this blindly. You need to understand where you are in the bigger picture. We'll dive into a couple of examples to make this clear. So in the first example, you can clearly see that the market is bearish. Then it prints an inside bar candle, which means we're now in a range. We mark out the high and low of that range. Simple. Now watch what happens. The market sweeps the lower side of the range. But here's the key. It does that with a higher time frame key level tap. And right after that, the market reverses and takes the buy side liquidity of the range. Clean range play. Let's dive into our second example. So in the second example, you can see that the market drops lower. Then it prints an inside bar candle. What do we do next? We mark out the high and low of that range candle. Simple and mechanical. After that, the market starts to move sideways, staying in a range for quite a while. Then comes the move. Price takes out the buy side of the range and taps into a key level above, which in this case is an FVEG. And from there, clean rejection. It rolls over and takes the sell side of the range. Let's move on to our next example. In this example, you can clearly see the market trending bullish, but then forms an inside bar candle. What's the first step? We mark out the high and low of that inside bar candle. Now listen carefully. We don't trade this as a pattern. We trade as context. Watch what happens next. Price comes down, sweeps the range low first. And exactly there, it taps into a bullish fair value gap, our key level. Right after that, the market explodes upward and takes out the range highs. Boom. That's the power of trading ranges with context. If you're trading ranges, you need to take this into context. Don't treat it as just a pattern. Always trade it with context. That means higher time frame, key levels, and ideally, an SMT at the range. That's your additional confluence. Now here's the deal. If this video gets 100 likes, I will drop an advanced lesson about trading ranges. If you found this video educational and useful, give it a like. And if you want more trading education, don't forget to hit that subscribe button. See you in the next video.